Hey guys, another Thursday, another webinar tonight. So please register to it because this is going to be a very important webinar where I'm going to go through all of the FOMC minutes, statement, and make it clear for everyone what's going on with the US dollar. As you guys can see, we did have the Fed coming in yesterday as well as the FOMC doing the rate statement. And it was mostly predicted by the market. But now we are definitely sure that we're going to have 3 rate cuts by the end of 2024, by the end of this year. So I'm going to be making all of this clear for you so you don't have to go through all alone. So it's very simple. You can just go down at the description of this video or you go to ACY website and go into learn and go into webinars and seminars and click in there and then wait for the page to load. Wait a few seconds for the page to load and then you click on my name and then join me or register or something like that. Now, before we start, please give us a thumbs up on this video, subscribe to the channel and put the ring bell activated so then you don't lose any updates we do here in the channel every day. We do have videos every day. Every single day we have videos talking about economic as well as technical points on the charts. All right. And last but not least, if you haven't joined my webinar yet, where you would be receiving analysis like these ones, as you can see right now on the screen, please do so. All right. It's free. I've opened up. It's not all of the videos. I'm leaving the Telegram link on the description. But it's going to be the first link on the description, all right, or in the comments. So go and do that because otherwise, if you're not there, what are you doing? All right, let's go. We had the Fed and my Telegram group already know, all right? So this video is getting off at 3 p.m. The Telegram group already knew it afterwards, the Fed. So it's quicker, much quicker. So you get updates much quicker. 3 times quicker than waiting for a video, and so on. So be there. Now, as we saw, I want to talk about 2 things. I want to talk about New Zealand getting into a technical recession as well as US FOMC. So as you guys can see right on this screen, right on this photo here, we had this morning at 8:45 New Zealand GDP growth rate year over year and quarter over quarter. The year over year came at negative 0.3%. The consensus was to come positive 0.1%. And the previous was negative 0.6%. All right, last year, 2022. Sorry, 2 years ago, 2022. And the quarter over quarter came negative 0.1%. The expected was 0.1% positive, and the previous quarter was at negative 0.3%. So all of the consensus, most of the economists were predicting to be positive. And we had this massive change to negative, even year over year, as well as quarter over quarter. And if we look to the New Zealand dollar right now trading at 60 cents and 93, we can see that it didn't, it did felt, of course, in a sense, but the dollar is so weak at the moment that it went up. So, even though they are on a technical recession, they did had a very bad, if we put into the 1 hour, we can see a very strong candle to the downside. But right now we are going up because of the US dollar that I'm going to be talking in a second. New Zealand has just released it, this morning, and they are on a recession. Okay, economists traditionally define a recession as 2 consecutive quarters in which the economy contracts. The New Zealand dollar is dropping sharply at the time when there is not much liquidity in the markets. That was this morning. All right. Now, going to the Fed, and I want to stay with me until the end. I want to talk a little bit about UK CPIs as well. But all right, I have a few snippets here from the Fed from this morning at 5 a.m., 5:30 a.m. That I'm going to read it through. So it's going to be exactly the same words, all right? But first, yes, they did pause the rates as widely expected. You know, most of the market was already, 90% of the market was expect. Well, 99.99% of the market did expect already a pause from FOMC today. And to be honest, very, very, clear a pause. But as I've always mentioned it's not about what the Fed will do, if they want to pause or if they will, increase rates. It's what they will say about it. All right, and as we just had it as well, I'm going to read it through. So Powell said, if there were a significant weakening in the labor market, that would be a reason to start cutting rates. And as we see, the NFP, that's the labor market, the non-farmer payroll, it's how many jobs we had additioned from the month or from the past month. Usually, it's on the first Friday of the month, so reflects the last month, came positive. So it's not cooling off yet, but the unemployment rate is still going higher. Okay, and he goes, in the labor market, if we have a lot of supply and demand, we could potentially have a larger economy where inflationary pressures do not increase. Strong hiring alone would not be a reason to delay rate cuts. So when he say that strong hiring alone, he's mentioning about the NFP, would not be a reason to delay rate cuts. So even though we have higher NFP, this is why we felt so much, because the market was thinking, okay, we are having a Fed, we are having a US with higher NFP, all right? This is something that the Powell always look to it. I'm just thinking in third person here as, as the market. So the Fed always look to it, as Jerome Powell always say, they will be looking to stronger labor market and everything. If it's too strong, we're not going to cut. So they did, and now they change it, all right? And they're saying that stronger hiring, stronger NFPs alone would not be a reason to delay rate cuts. So we are having higher NFPs, so this is not going to be a reason to delay the rate cuts. But he already said rate cuts. So that's a big take already to the market, all right? Because he wasn't talking about that until December. And now he is. So that's a very big step, I would call it, all right? And he goes further. We need time to assess whether the recent inflation represents more than obstacles along the way. What does he mean by that is, because we did have January, February, and March now with high inflation. So we did have high inflation from US, and it's not going down. It's this sticky inflation. Even though if, I'm going to go through those numbers tonight, so make sure to be registered to the webinar. He stated that sticky inflations will be continued through this year, all right? And that it will only normalize next year in 2025. And that the GDP will be much worse, so won't have as the same effect as we had in quarter 3, for instance, last year, 2023, that was much higher, more than 3.2%. All right. Now, many saw possible seasonal issues in the January inflation print, as I just mentioned, but he said that we don't know if this is a bump, if it's just a bump in the road for inflation or something more serious. Okay, so that's all of I have for you guys, all of the other stuff that we'll be talking tonight. And again, please join us on the Telegram, all right? It's a full chat. Most of the days, let's say we have 5 days in the week, business days in the week, 3 or 4 business, 3 or 4 days, I'm in there, all right? Sending analysis to you guys. So please, subscribe to the channel, give it a thumbs up. It's very, very important for you guys to maintain yourself informed during these, bumpy roads of the market. And this is why we're here, all right? This is why ACY are here, to make you comfortable to go ahead with your trading. All right, guys, I stay here, and I hope everyone have a safe trading week, today and tomorrow. And if you have any questions, please put it down in the comments or join the Telegram and then ask for talk to me. All right, see you tonight. Bye-bye.